day, and welcome to the Q1 FY2025 earnings conference call of Axiscades Technologies Limited, hosted by Centrum Broking. As a reminder, all the participants' line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sumit Khetan from Orient Capital. Thank you, and over to you, sir.
Thank you very much. Good evening, everyone, and I'm delighted to welcome you all to the earnings conference call to discuss Q1 FY25 results of Axiscades Technologies Limited. To discuss the results, we have with us CEO and Managing Director, Mr. Arun Krishnamurthy, Mr. Mujahid Alam, CEO Mistral, and our Group CFO, Mr. Shashidhar SK. They will take you through our results and business performance, after which we shall proceed for question and answer session. Before we begin the call, I would like to mention that this conference call may contain some forward-looking statements about the company, which are based on belief, opinion, and expectations of the company as on date of this call. The actual results may differ materially. These statements are not guaranteeing the future performance of the company and involve risks and uncertainties that are difficult to predict. With this, I now hand over the call to Mr. Arun Krishnamurthy for his opening remarks. Over to you, Arun, sir.
Yeah, thank you very much, and good evening, everyone. Welcome to the Q1 FY25 earnings call. I'm joined by Sashi, who's our Group CFO, and Mutu, who's our CEO of Mistral. I hope you had the opportunity to review our financial results and investor presentation, which has been uploaded to the stock exchanges. So let me first dwell on the overall ER&D industry growth outlook, which directly impacts the company. The ER&D industry is currently undergoing short to medium-term headwinds in the growth outlook. There are headwinds in several verticals such as automotive, heavy engineering, and semiconductors, both in US and Europe. Decline in retail demand, slowdown in the EV segment, upcoming US elections, leading to slowdown in capex spending, client-specific issues, inventory build-up, deferment of R&D spend on innovation, and new engineering solutions are all challenges that the industry will have to deal with. Sectors which are still positive are aerospace and defense, both of which are seeing accelerated spending because of the unique context of these industries. Despite this, ER&D continues to be a growth sector, with average growth of around 7.5%, with digital revenues growing at an accelerated pace. The impact of industry slowdown is relatively moderate on Axiscades because of the effective execution of a focused strategy over the last 2 years aimed at diversifying our customer base and verticals. We are particularly well placed in aerospace and defense and have very differentiated capabilities which will allow us to take advantage of the strong sentiments in these verticals. We are positioned as a fully integrated strategic technologies, R&D and defense company that delivers a broad spectrum of products and services from engineering, aerospace, and space to defense. Therefore, we will be rebranding ourselves as Axiscades Mistral, and the name change will be pending regulatory and other statutory approvals. The company's strong presence in aerospace, defense, and energy, together contributing about 60% of the company's revenues, continues to reflect a bullish outlook for the year. Even though defense business, not part of revenue of other ER&D companies, by its very nature, is very lumpy and should not be compared quarter on quarter for its performance. The company is experiencing some slowness in automotive, some specific lines, heavy engineering, and the semiconductor business due to the earlier mentioned macro factors. However, the company is confident that the tide will turn in these verticals from H2. Q1 is typically a soft quarter for ER&D in general and defense in particular. The company recorded revenues of 223 crores, growing by 4.5% year-on-year, with constant dollar growth at 3%. It was led by engineering services business, which grew by 15% from 152 crores to 175 crores. Defense was lower by 21% at 48 crores, as against 62 crores in Q1 of last year. As stated earlier, the defense business should only be compared on a year-on-year, as defense deliveries generally shift and roll over between quarters, depending on delivery and acceptance constraints of defense establishments. The EBITDA for the quarter was at 31 crores at an EBITDA margin of 13.9%, as against 33 crores with an EBITDA margin of 15.4% in the same period of the previous year. The EBITDA margin for previous year, Q1 FY24, that is, was unusually high due to higher defense service revenues, which had an EBITDA margin of 23%. I would like to reiterate that the total enterprise EBITDA margin in each quarter depends on the proportion of defense production and prototype revenues executed during the quarter, which tends to vary between quarters. The EBITDA margin of engineering services for Q1 of this year is at 14% as against 13% in the same period of the previous year. PAT for Q1 FY25 is at 17 crores with a margin of 7.2% as against PAT of 6 crores with a margin of 2.6% in Q1 of last year. The company reduced its finance costs significantly during the quarter from 20 crores in Q1 of last year to 8 crores in Q1 of this year. And this is as a result of repayment of borrowings from the proceeds of the QIP. In terms of operational performance, the year-on-year growth of 15% in engineering services was led by aerospace, automotive and energy, which together grew by 40% from 82 crores to 115 crores. Heavy engineering and semiconductor business degrew by 15% from 71 to 60 crores. As stated earlier, these two verticals are impacted by macro challenges of capex degrowth and inventory buildup, and we are hopeful that growth will return to these verticals from H2 of this year. While the overall defense revenues in the quarter was lower at 48 crores, as against 62 crores in the same period of the previous year, the defense production revenues at 28 crores is higher by 73% as compared to Q1 of last year. The company's production revenues from defense will record another milestone in the FY25 with a strong order book of 322 crores at the end of Q1 FY25 in the Mistral defense business. We continue to deliver counter-drone solutions to Indian defense and wish to complete the delivery of this anti-drone system in Q3 of this year, which will make us a prime candidate for repeat orders in this category. I will now dwell on the performance and outlook for various verticals. The aerospace vertical accounted for 36% of our Q1 revenues, totaling 79 crores and reflecting a 24% increase from the previous year. This growth was driven by higher wallet share from existing customers, ramp up in our services, and the digital automation of our existing processes. Our long-standing partnerships with aerospace OEMs are growing steadily and are expected to contribute further to the revenue as OEMs increase production rates, supported by the substantial order backlog, which is driven by a strong demand for aircraft. We anticipate maintaining a healthy growth rate and momentum backed by a broadening scope of digital manufacturing services and engagement with our customers. Our outlook for aerospace continues to be bullish for the foreseeable future. Our automotive revenues of 25 crores is higher by 84% from the same period of the previous year, with the consolidation of revenue pertaining to Ag Solutions, the automotive entity that we acquired in August of last year. Automotive revenue today constitutes 7% of the consolidated revenues, which was at 6% in Q1 of last year. We were selected as a preferred supplier by a leading UK automotive OEM and are actively expanding in this space by adding new logos. Our major focus going forward will be on digital and embedded solutions as well as hardware testing and validation. We are developing capabilities in margin accretive segments like software testing, cybersecurity, ADAS, and investing in new technology trends which are in great demand apart from the traditional focus on mechanical. However, due to macro challenges in this sector, such as a notable slowdown in the European markets and change in strategy by an automotive OEM, we expect the next 2 quarters to be challenging in this vertical for us. We ended Q1 with revenues from our energy vertical reaching 11 crores, which accounts for 5% of our total revenue. The addition of Ecogen has provided a strong boost to our growth in the energy sector. We have been selected as a preferred partner for 2 new projects in the UK with a renewable energy solutions provider and are expanding our customer base in India and the Middle East. The company has appointed a full-time business head in Dubai and is in the process of opening a marketing office in Dubai to expand our footprint in this major energy geography. With new leads in this segment, ongoing geographic diversification, and development of new capabilities in this vertical, we anticipate the growth momentum in this segment to continue. The heavy engineering and semiconductor business continue to face margin pressures. Revenue in the heavy engineering vertical decreased by 8% year-on-year from 40 to 36 crores in Q1 of this year. This decline is primarily due to macroeconomic factors, a slowdown in the US region, and customer reprioritization of capex across various programs. Despite this, we remain a key strategic partner for our customers in their global manufacturing transformation initiatives. The objective is to move away from traditional low-margin staffing model to margin-accretive value-added services and sell digital competencies for internal automation to global and domestic clients. To enhance the revenue quality of this vertical, we are developing several use cases by leveraging our in-house capabilities and those from Mistral. By revamping our cost structure and optimizing operations, we aim to improve margins in the coming quarters. We anticipate this vertical will begin to recover starting in Q2 of this year. Our semiconductor vertical revenues, also known as product engineering services, for the quarter stood at 24 crores, which is a year-on-year degrowth from 31 crores, down by 23%. This was mainly due to the inventory buildup of semiconductor chips by global semiconductor majors, leading to production decline. Despite the decline, we are diversifying our customers within this space and increasing our efforts in designing and prototyping for future production runs. The Indian government is supporting Make in India initiatives for semiconductor fabrication, and globally we expect that growth will return to this vertical during H2 of this year upon offloading excess inventory by the OEMs. While I will leave it to Muju to deliberate on the opportunities and status of defense vertical, we remain bullish on our defense potential, banking on evolving production orders from the significant pipeline of prototype developments of Mistral for prestigious Indian defense programs made over the last 1+ decade, as well as potential in ACAC. Suffice it to say that the defense production orders in FY25 will be significantly higher than that of FY24, while we continue to add to the pipeline of orders with certified programs, prototypes for new programs. As stated in our earlier earnings calls, the company is making significant investment in building its digital strength, which is being horizontally deployed across all our verticals and customers, both in terms of internal automation as well as digital offerings to our existing new customers. The digital investments, which are part of our P&L charts and continues to be margin accretive, is now fructifying into new order acquisitions as well as internal cost optimization, and will result in new revenues and improved profitability as the year progresses. The company is also bolstering its sales organization and has recently onboarded a head of sales in the US region to expand our presence in the region and acquire new deals. The company's confirmed order book beginning of Q2 FY25 is at $83 million. With continued acquisition of new deals, both in engineering services and defense. We are also pleased to announce the appointment of Mr. Concall as an additional director in the capacity of non-exec independent director on our board. Mr. Chakraborty brings with him a distinguished career spanning across 4 decades with extensive expertise in corporate strategy, government affairs, and digital transformation. He has held prominent positions in the Tata Group, mainly heading governmental affairs. Looking ahead into the full year FY25, we are confident of delivering as per plan, both in terms of revenue and profitability, by leveraging on the opportunities in our growth verticals as well as overcoming the challenges in some of our verticals. Let me conclude by thanking you for your patronage and look forward to continued support as we build a marquee institution in the engineering services and defense. I now invite Muju to provide a view of the Mistral business.
Thank you, Arun. As we all know, Mistral is a technology design and system engineering company serving customers primarily in the semiconductor and defense vertical for over 27 years. The company has achieved a growth rate of 20% CAGR in the last 5 years. FY24 revenue was 328 crores with an EBITDA of 56 crores. Besides our strong presence in the product engineering space, we have firmly established ourselves as a major defense solution provider. We work closely with DRDO labs, public sector units like TA, HAL, and Ministry of Defense. We are an integral part of many radar, sonar, airport, and aircraft warfare projects. Currently, Mistral has bagged more than 800 to 1,000 crores in certified prototypes across multiple prestigious Indian defense programs and awaiting production orders. Additionally, new design wins with a potential of 2,500 to 2,000 crores in future production are under development. The company's order book at the beginning of Q2 of FY25 stands at 375 crores, which was 60% scheduled for execution this financial year. In Q1 of FY25, Mistral recorded revenue of 52 crores compared to 72 crores in the same period of the previous year. Of this, 23 crores came from semiconductor business and 41 from defense business. The company achieved an EBITDA of 7.5 crores during the quarter with an EBITDA margin of 11.5%. As Arun mentioned, the defense business experiences variability in both revenue and margins when compared quarter-on-quarter. Defense margin may also get diluted by the quantum of prototypes being designed. These prototypes development mostly have negative margins during design phase and become largely profitable during production. Therefore, it is essential to maintain a long-term perspective on the defense business rather than a short to medium-term view. The softness in the semiconductor business due to inventory overload with OEM is likely to continue for another 2 quarters. We are actively working to increase our business of newly added clients in the automotive sector. We are also on track to add 2 to 3 new customers in upcoming quarters. The new drone kit based on Qualcomm is under development and will be released in the market in Q3 of FY25. Mistral has secured an order for 90 crores from TEL, the defense PSU, for 8 radar processing systems for the medium power radar Arunda. The delivery for the same will begin in this financial year. We are confident the semiconductor business will return to growth and the defense vertical will maintain its bullish trajectory supported by a strong order pipeline. I now invite Mr. Shashidhar, Group CFO, to provide a financial report. Thank you.
Thank you, Muthu, and thank you everyone for joining the earnings call for Q1 FY25. On the back of headwinds in certain verticals due to macro factors, as explained by Arun and Muthu, lumpiness in defense, and generally a soft first quarter, the company has recorded good results with operating revenue of 223 crores, a 4.5% quarter-on-quarter growth, 31 crores in EBITDA, and 13.9% in EBITDA margin. The company recorded a PAT of 17 crores, which was almost 3 times the PAT recorded in Q1 FY24. As appraised in the earlier earnings call, the company's finance costs have significantly reduced as a result of repayment of borrowing, amounting to 110 crores, the QAP rise in January of 2024. The company's finance cost for Q1 25 was at 8.07 crores, which is a significant reduction as against 20.1 crores recorded in Q1 FY24 and 12.51 crores recorded in Q4 of FY24. The company is scheduled to repay another 50 crores of its borrowing by end of September 24, which will further reduce the finance cost. Our net debt as of 30th June is 50 crores, considering 182 crores in cash, bank and liquid investments. Our steadfast focus continues to be on improving our operating discipline with the twin objective of improving gross margins and controlling our operating expenses. We have launched many cost rationalization initiatives, both on variable cost and fixed operating expenses, especially focusing on below 20% gross margin accounts to improve our blended margin. Our digital vertical, while still its margin integrity, is focusing its efforts on internal automation of billable processes to improve revenue per employee, as well as acquiring new digital revenues from existing and new customers at higher billing rates. We have strengthened the delivery organization with a focus on resource management, optimization of the pyramid, and maintaining the bench. Our offshore on-site ratio stands at 31:29, and fixed cost P&L ratios is at a healthy 65:35 respectively. We added a net 70 FTEs since the beginning of the year, with reduction in attrition rates to 14% from 18% as compared to the same period of previous year. The annualized ROCE based on Q1 results is at 17% against 14% where we ended in FY24. Annualized ROE stands at 11% as against less than 7% in FY24. The annualized EPS is at 16.27 as against 8.40 in FY24. The company has a strong balance sheet with net worth standing at 596 crores at a consolidated level as of 30th June, with sufficient cash generation to comfortably service our debt obligations and generate free cash flows. Our net working capital cycle as of 30th June is at 118 days, despite working capital heavy defense business constituting 28% of the revenues, and we continue to optimize our working capital terms. The company has enhanced its governance process by appointing a global controller to oversee internal control, risk management, and has appointed a general counsel to oversee corporate governance for the entire group. In conclusion, over the past several quarters, we have made significant strides in establishing a foundation for sustainable growth and profitability while strengthening our balance sheet. We are confident in our ability to build on this momentum throughout FY25 and beyond. Thank you. Now I request the moderator to open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Jalaj from Swan Investments. Please go ahead.
Hi. Thanks for the opportunity. Hope I'm audible.
Yes, you are.
So I had a few set of questions. Maybe I will begin with them. Firstly, I wanted to understand with regards to defense, and from the past 3 quarters, we've been having a lumpy period there. We have been talking about defense revenue picking up and order books being strong. What is exactly happening, and when do we expect the production revenues to pick up, and what sort of at least outlook or number-wise do you have for this financial year in the defense vertical?
Yeah, so thanks for that question. So if you look at our Q4 results, we had a very strong production run. And, the defense business by its nature is lumpy because we work with some large PSUs and, with government customers. So it is hard for us to calibrate this on a quarter-on-quarter basis. So last year we had a very good production run. This year, again, we are looking at about close to 171 crores of production for FY25. And Q1 was slow in terms of production, and that's traditionally always the case. But we do expect that next quarter for us, Q2 will be strong when it comes to production. So it will be lumpy, but there are certain quarters where we expect strong defense production runs to happen.
Understood. Okay, and in the defense, could you talk a little about, maybe that's a little deep diving into it, the contribution from the anti-drone revenues or the vertical product per se. And there's one more thing, in this 170 crores, have we assumed something with regards to Tejas? Because I understand that HAL has given guidance.
Yeah, sorry to interrupt you, but I think your line is not very clear at the moment. Can you just repeat that question?
Sure.
Take closer to the phone.
Sure. Am I audible now?
It's too much echo in your voice.
Just a sec. Yeah. Is it better? Yeah. So I was trying to delve a little deeper into the defense vertical. So one thing is, how are we right now positioned on the anti-drone revenue started to flow into starting contributing to the top line, and I understand that HAL in its recent Concall talked about the revenues for Tejas being a little delayed because there were some issues with the GE engines. In this 170 crore target that we have talked about, is there an assumption with regards to Tejas something, or how confident are we about this, and how does that impact us, the HAL issue?
Yeah, so let me first answer your question with respect to the LTCDs of the anti-drone deliveries. As we have been reporting of the 100 numbers which have to be delivered to the Ministry of Defense, 40 have already been delivered and 60 is being scheduled between Q2 and Q3. And talking about revenues, we recognize revenues on a proportionate completion method. So of the 65 crores of revenues which belong to us, which is in our share, we have recognized about 50 odd crores, and close to about 40 to 15 crores is still to be recognized, which will be recognized between Q2 and Q3.
Yeah. On the LCA production delays, we have factored in the delays in our projections because though the issue is with the GE engine, and what we have looked into is about 14 to 15 numbers of LCA being produced annually, and that is what we have given in our projections of what is in our planned projections for this year and next financial year. So it should not impact in terms of our revenues.
Understood. And this was with regards to the margins. I do understand that there is some reversal corresponding to the ESOP provisions in the margins this quarter to the tune of almost 12 crores. If I were to adjust them, then the EBITDA margins would have an impact of almost 450 to 400 to 450 bits. Could you talk a little about it, and where are we actually feeling the pressure in the margins? Is it all across, or particularly R&D, some vertical specific, are we facing issues? Thank you.
Yeah, so maybe I can take that question and Sashi can add on. So I think like we talked about, there are verticals that we have some seasonality. So if you look at vertical by vertical, if you look at aerospace, obviously that vertical is doing very well for us, and I think we are at very healthy margins. If you look at defense, like we talked about it, there is lumpiness. So quarter on quarter, there are different circumstances. This quarter on defense, we had some pressures on margin because of the fact that we had to invest in a lot of prototypes. But like I said, our production revenues next quarter are going to be very strong, so we'll see a big uptick happening there. If you look at energy, that business is very robust for us, and it's a very high margin business. Now, if you look at semiconductors, there are two parts of the business. One part is the NRE or the non-recurring business, which is basically the services business, where the margins are very high. Where we suffer on semiconductors is the production slowdown. And this, as you know, is an industry phenomena where there's been high inventory, and we expect that situation to improve as we go into the year. So there has been some stress because of that, because typically production, whether it is defense or semiconductor, comes with very high margins. In automotive, we have a specific client issue. One of our clients in one of the European countries has faced a bit of a slowdown, and they're in the middle of a restructuring exercise. So because of that, we have had some margin pressures, which again, I believe, they're a large client, and they will come back. So we expect that in 1 or 2 quarters time that customer should come back and that will contribute to it. But because it's a big part of our portfolio, that has had a specific impact on us. And heavy engineering for us, the margins have been pretty much steady. So it's a bit of a mixed bag. I would say the margin pressures in this quarter specifically are from defense and from automotive and from some parts of PVs or semiconductors.
Yeah, so just to add to what Arun said, just to take the example of Mistral Defense. In the current quarter, the total defense production of Mistral was 28 crores, which is almost about 75% more than what they recorded in the same period of last year. So on this defense production of 27.5 crores, the EBITDA which was recorded was 24.72%, which is about 6.8 crores. But when it comes to defense prototypes, the total revenue from the defense prototypes, which is for future pipeline of orders, was 13.87 crores, on which the company lost 3 crores, which is almost about 21%. On this count, of course, Muthu will add to this. There's a lot more, the prototype, I would say, acquisition of orders for prototypes has become a lot more competitive. And if you look at last year, FY24, the whole of the year, we had the total prototype production was around 91 crores, on which we had lost about 3.9 crores. Whereas in this quarter alone, or it's 13.87 crore revenue, we recorded a negative margin of 2.9 crores, which is almost 21%. But we have to, of course, do this because we have to add to the production order pipeline. And if we do not do this, obviously our margins will improve dramatically. But we are playing for the long term with respect to defense, and we have to continue to manufacture this prototype. Would you want to say something on this?
And see, defense is a long-term business. So basically, what we need to do is today we need to get ourselves involved into multiple new programs which have been planned by the Indian Ministry of Defense. So if we are not there in the program today, we do those when the production happens. For instance, if we had not been in the LCA program many years back, because we got an LCA program almost 15 years back, those benefits are being reaped today. So this is investment which we do in the longer run. But unlike in the earlier years wherein the benefit happened after 15 years, now we see hoping that things will, what we do today will roll out into production numbers in 3 to 5 years from now. So basically the investment for tomorrow.
Got it. Understood. And one last quick question, if I may be. So,
maybe I request you to return to the question queue
for
follow-up.
Thank you.
Thank you. The next question is from the line of Jyoti Singh from Arihant Capital Markets Limited. Please go ahead.
Yeah, thank you for the opportunity. So just only clarification on the automotive segment side. Like you mentioned, some client issue was there. So it will, we are expecting in the upcoming quarter also. And another on the defense side, we are seeing lumpiness and we are already multiple segment. So is there any, I hope not a focus issue because we are trying to manage a number of segments. So what are view going forward from here onward?
Yes, so Jyoti, thanks for the question. So I think in automotive it's a very specific, like I said, customer issue. And just to give you a bit of a context on automotive, what's happening is that a lot of OEMs are migrating their portfolio towards EVs, electric vehicles. But what's also happening is that there's a lot of competition which is coming from Chinese OEMs. And because of this is putting a lot of the traditional OEMs who are trying to disintermediate this business into a lot of pressure. And they are trying to adopt ADAS and connected and embedded facilities in the car, which is happening at a slower pace. So what we are seeing is a short-term impact, but given the fact that these are very marquee names, it is just a matter of time before they come back. So since we have a large book of business from this customer, as the customer recovers, we'll see the recovery happening. It is not something which is systemic. I think it is more a time-based issue. As far as defense is concerned, we are very focused actually. I think this is a core area for us. We have two parts of the business which are now merging together. So we work with, on one side with all the labs like the DRDO, NID, etc., and the PSUs like HAL, BEL, etc. On the other hand, we work with the Ministry of Defense. So our portfolio actually is very focused. It's actually, if you look at it on the lab side, we do a lot of work on the electronics side, which is on telemetry, which is on radar and so on. And again, with the Ministry of Defense, we work on the anti-drone as well as simulators with the PSC. So we are actually very focused on the electronic side of the defense business. So it is actually very strategic for us. It is a growing area. And, we are not spread into multiple areas like, your question suggests. But actually, very, very focused. And this is actually the right place to be in because there is a lot of growth which is going to happen here, as we all know. Is there anything you want to add on the focus part of defense?
As a company, we are very clearly focused because the team which is working on the non-defense portfolio is completely different and the team which is working on the defense portfolio is totally separate. So we all have our strengths and we are very clear about what we are doing because the semiconductor business and the general CS business require a different mindset as together. And the defense portfolio requires a completely different mindset and the people who have been engaged with defense, the average age in this or across both the entities combined together is about more than 10 to 12 years in this alone. So that gives a very clear vision saying that these people are completely focused on defense sector.
So the
Okay, great, sir. Thank you so much. And sir, on the semiconductor side, that the production issue we are facing, what are the expectations on that front?
The semiconductor business, there is still overstocking by multiple OEMs. We expect this business to take off by Q3 or Q4 of this financial year.
Okay, thank you so much.
Thank you. The next question is from the line of Deepak Padar from Sapphire Capital. Please go ahead.
Yeah, hi, I'm audible.
Yes, you are.
Yeah, okay. Thank you very much, sir, for this opportunity. So just wanted to understand now we were talking about the margins pressure driven by 2-3 sectors like automotive, defense, semiconductor, as well as automotive not doing that well. So in light of, and I think we also mentioned that all these sectors will take maybe 1 to 2 quarters for them to revive. I mean, so how do we see then the growth part and the margins part for this year? I mean, this quarter our adjusted margin was close to 8.5%, right? So how one should look as a whole year as a whole in terms of growth and margins here?
Yeah, so a large part of our margin contribution comes from defense, and that sort of accounts for when we have low margin as well as when we have high margin. So I think we are going into a quarter now, or rather we are in Q2, where we expect like a better production runs to pick up. So we expect a strong margin performance to happen in Q2. A lot of that will be contributed by our defense business. And of course, on the engineering side as well, sectors like aerospace are very strong. So like I mentioned in my opening remarks, I think if you look at the headwinds that are impacting ER&D, the two shining lights are aerospace and defense. Aerospace, one is because it's always a long-term game. And, air travel is picking up, people are traveling more, and then, some of the OEMs are very strong order books. So we are unique that we are one of the ER&D companies who's positioned in aerospace, which is differentiated from a lot of other companies. So that will be a strong performer for us. And again, because defense is part of our portfolio, we expect, as defense, ramps up, that will grow. So like Shashi said, last year we did 90 crores worth of production in defense. This year we will do 171 crores. So a lot of that hasn't happened. So you can expect a lot of that to happen over the next 3 quarters. But we are looking at getting into a quarter where we have good defense business. So that will provide a lot of the margin benefits.
For the year as a whole, I mean for FY25 as a whole, in terms of growth and both margins, how do we see that?
Yeah, so we are doing a combination of things. One is, of course, because the defense production is high, that will be a contributor. The second thing is that we are also, like I mentioned in my opening remarks, we're looking at a lot of digital as well as cost optimization initiatives which will happen, which have already played out. And, some of these cost initiatives take, 3-4 months to actually show up on the balance sheet. So we expect all of that to start appearing in the next few months and next few quarters. So we believe that for the whole year, I think we have a good plan in terms of both top line as well as EBITDA.
Both top line as well as in terms of EBITDA. And are we still maintaining FY26 that we had guided earlier 3-year vision of 1,600 crores kind of a top line and a bottom line of maybe 160, 180 crores?
Yes. That's the plan we're still working on. So, we're hoping to have a strong year this year, and then that will build into what we get into next year.
Okay. And just one last small thing. Finance cost, we spoke that we are repaying some debt, so we expect some finance cost reduction. So what sort of finance costs we are looking at for this year?
It will be around 30 odd crores.
Okay.
Out of the 56 crores that what was there for FY24, we should be around 30 crores in terms of finance cost. More than that.
Oh, I got it. I think that's it from my side. All the very best to you. Thank you so much.
Thank you. The next question is from the line of Kaushik Mohan from Ashika. Please go ahead.
Hi, sir. Sir, I just wanted to understand one basic question. What are our components in the other income that we have? Because this time we have recorded a huge other income, right? Can you give the breakup?
See, essentially the other income, major part of the other income of 11 crores at what we see in Q1. 6.59 crores of that is capital gains. We had a property in Noida, which was kind of unused, so we monetized that. And we made a 6.59 crores capital gain out of it. The rest of it is of course the interest income and all of that in terms of the expenses that what we have faced majorly.
Okay. So this one-time income of capital gain, if I remove, then our PAT is not having such a kind of a growth, no, sir. Like where are we lagging? Which division is of concern? Because I joined very late, so if I'm repeating the question, I'm sorry.
See, as Arun explained, for us, aerospace and defense are the front runners in terms of both revenue and margins. As Arun was saying, with respect to aerospace, our EBITDA margins is close to 19%, and with respect to defense, as I told you in the first quarter, we may had about 28 crores of production revenues, and that gave us about 24% EBITDA margin. Even with respect to product engineering services, our EBITDA margins are of course of 18%, only that the growth has to return as what we just stated. So the ones which are compressing the margins are the heavy engineering vertical, where predominantly it is a staffing business. That's where Arun said that we are completely revamping this entire heavy engineering vertical. So if you, in fact, remove the heavy engineering vertical from the scheme of things, which is about 20% in terms of revenue, our EBITDA margins will actually go up by about 100 to 150 basis points. But that's where we are taking a major correction in terms of moving away from this staffing model as what we are talking about. And the other vertical where, because of the degrowth in terms of the OEM business, is the automotive business, where we saw a compression of margins, and that will come back from about Q2 end and Q3 onwards. And energy, of course, is a high yielding margin business for us of the, say close to about 11 crores of revenue which we recorded for the energy business. The EBITDA there again is about upwards of 20%.
Got it. Sir, are we sticking on to our guidance of 170 crore guidance, or are we upgrading, or are we looking at it, rechecking it?
I'm not sure as to where I got this number, but the guidance with respect to the EBITDA, as we are progressing from Q2, Q3, and Q4, we are as per plan.
Okay. Thanks, sir. Thanks.
Thank you. The next question is from the line of Aman Vij from Astute Investment Management. Please go ahead.
Good evening, sir. My first question is, you have talked about 800 to 1,000 crore of approved production wins. So if you can talk about how much can we expect in FY25 and
We currently have production visibility of 300 crores of production based on the efforts which we have put in the past. So these are the efforts which Vishal and the team has put in the last 15-20 years. These are yielding us production revenues. So as on date, we have approximately about 375 crores of order book on hand, out of the difference is about 300 crores in hand, and most of this will be executed in the next 1 to 2 years.
No, sir. That number you have, that is known. But I was asking that the number which you mentioned, 800 to 1,000 crore of approved wins. So only 300 crore do you think will come for FY25, and next year FY26 out of this 1,000 odd crore, how much can be the order inflow for us?
See, as has been reported in the investor presentation, of the 324 crores of order book as what we have in defense, about 60% will be converted this year. The rest of it move to the next year. And again, of the total 800 to 1,000 crores as what we have stated, where there are all approved prototypes, where we have a part number and a reasonable visibility in terms of when the production orders are going to kick in. We will start with a strong order book at the beginning of FY26 again. Essentially to say, this 800 crores will perhaps convert over the next 2 to 3 years.
Sure, sir. And if you can talk about how much of these will be like L1 tender based versus how many of these 800 to 1,000 crore we would be the single vendor?
In most of the cases which have been certified and approved in the past, here it is only a part reissue of the order, because there will be no other competition as such, because we have been engaged with the customer in building the prototype, and the designs which we have done have gone through multiple testing cycles and manufacturing cycles. So these parts will typically not be changed, so it will be on a single tender basis.
So as we have been talking about it from the past so many earnings calls, once a prototype is developed and certified and we have a part number, that becomes an IPR for us, and it is, when a total system is developed, that part number purpose has to be there in the system. So it almost becomes a single tender.
Okay, so most of then my assumption is correct that most of it will be single tender out of this 800,000 crore. There won't be even a second player.
Yes, your understanding is correct.
Sure, sir. Next question is, if you can give updates on 2 of the programs, sir. We used to talk about it a lot more in earlier presentations, like Uttam Aisa radar, as well as the new Ashwani radars. So another player is winning a lot of orders in this. So if you can talk about these.
So voice is very, your voice is not audible, not clear.
Yeah, just a second. Is it better now?
Yeah.
Yeah, I was saying, sir, I just wanted an update on 2 of the projects. One is Uttam Aisa radar, and the second is on the Ashwani radar. So a lot of orders are coming for other players in this. So if you can talk about what kind of order inflows we expect from this Ashwani radar.
In the Ashwani radar, the TOT in the past was given to only one single company, which was Ashwani Electronics, and today there is an amendment in the TOT transfer agreement, and TOT has been given to 3 different companies. So there is a portion of Vista of the Ashwani radar, which will definitely come to us, and as on date, while we talk, we have given a quotation to all the 3 companies, so whoever wins, we will get our buy. And as far as the ESR radar is concerned, which is on the FCA, these trials have been good, and on 15th of August, the first prototype will fly out with the indigenous developed radar.
Yes, sir, just wanted to understand what product are we looking at.
Someone request you to return to the question queue for follow-ups. There are several participants waiting for their turn.
Yeah, ma'am. Just I'm finishing the question, and the next question I'll ask later. Just this part, just little bit clarity I wanted. Sir, I was asking that on the Uttam Aisa radar, typically the radar costs a lot, but what part are we doing? Is it a very small value addition or a big value addition? If you can talk about the same.
And there is a part called exciter receiver in the radar that is being done by us.
And this costs around like few crores, or these are like 50 crore plus kind of?
It will be in the range of about 2.5 to 5 crores approximately.
Okay, thank you. I'll get back in the queue.
Okay.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your questions to 2 per participant. I repeat, please limit your questions to 2 per participant. The next question will be from the line of Dipesh from MK Global. Please go ahead.
Yeah, thanks for the opportunity. Couple of questions. Just want to look, if I look organic basis, overall revenue is down on YOY basis and sizably down. Even if I look the vertical which you indicated is seeing headwind, even if you adjust for their flattish performance, revenue is down on organic basis. So just want to understand, it seems to be relatively more broad-based, particularly defense side. Defense is fairly weak compared to where we used to run rate perspective. And even from production and design which used to be stable, showing weakness. So if you can give some sense how one should look defense business, because you said it will pick up from production perspective, but then overall is not showing any material strength because of the design related softness. So if you can address 2-part question. First is organic fairly weak number, YOY basis. Second, even defense is showing weakness. So if you can address it, thanks.
Yeah, so the way we look at our business is that there are certain areas where we are legacy, where we have strong capabilities. And typically that is in aerospace, it's in defense, and it's in heavy engineering. And like I outlined, earlier as well, our strategy is to diversify. So that, when there are seasonalities which happen, like what is happening now, we are present in sectors which are strong as well. So to that end, we make acquisitions, and, for us, automotive, we group an acquisition and energy through an acquisition. So your question should be seen in the context that we have acquired new capabilities. So it is not that we are growing aerospace and defense through inorganic. The growth that you're seeing in aerospace and defense is completely inorganic. And defense for us is lumpy. That is something that, there's not much that can be done, because when we have production orders, it's a very high quarter. Like Q4, for example, was very strong for us, because we had a strong production run, and that has been showing even the next quarter is looking good for us. And Q1, which comes in between, is where we have to invest in a lot of prototypes. So the way I see it that, when one has to grow an overall business, one has to invest in certain areas, and there will be growth in other areas. So, and of course, meanwhile, there are also macro trends that we have to deal with. So I think given this whole context, I would say that the performance has to be looked at as organically, the sectors that are strong have done well. I think the new sectors for us, where, we have to grow quickly, and these are sectors where we could have grown organically, but then, it could take 5 years instead of doing it in 1 year. So I think the contribution which comes in from specific sectors where there are inorganic is because we wanted to grow quickly. So we feel that, because of the different seasonality, this quarter has been a little bit weak, and of course there is a client-specific issue in one particular vertical. But other than that, I think the health of the business looks, pretty robust as far as we are concerned.
So if you can answer the defense, products and design, one should look combined number from defense growth trajectory perspective, or emphasis should be more on products and design, lumpiness may continue? Because design is weak this quarter-on-quarter as well as on YOY basis.
In terms of production business, for the year we are well set and we have for the plan, because typically when we talk about production, you need to have your orders in hand at least about 9 to 18 months in advance, otherwise you will not be able to deliver. So we are in good shape for the year, and whatever investment which we are doing today is for the future.
No, that is true, but design, let's say when weakness was there, typically margin benefits should get reflected. If I adjust for some of the one-off, margin it seems to be weak. Even design revenue was weak.
No, so I think just to clarify, design for us is prototyping. So typically when a new defense program comes out, it is a competitive tender, and we have to bid against other companies. And usually there is a lot of pricing pressure when that happens. So you usually come in lower some price. Plus there is an investment because you need to do R&D. So design by the very nature of this tender will always be more in investment mode. But the reason we do design is because when the design finishes, once the certification finishes, the production which happens at the end of it is very substantial. And that's such a high when we have a quarter where there is more design and less production, that quarter will have lower margins because design, by definition is more investment, and production by definition is where we, harness all the margins. So next quarter, like I was saying, we have higher production as a component of our defense business, and therefore we expect that the margin will be very strong. So I think it's just important to understand the life cycle we are in. And in quarters in which there's more design, the margins are lower. I hope that clarifies.
No, so this clarifies, and that's why the question I raised. Your design is lower this time compared to, let's say, QOQ, YOY, whichever one look, absolute number. So it should have benefited your margin. And your production is also higher.
No, you see, just a minute. I think I answered this question earlier. If you look at Mistral defense this quarter, the total defense production for Mistral was 27.5 crores in this quarter, which recorded an EBITDA of 6.8 crores, which is 24.75%. Now, coming to defense prototypes, the total revenues from defense prototypes was 13.87 crores, where we lost 2.9 crores, which is almost 21%. So if you take the total defense margin from Mistral, it was about 41.37 crores of revenue and 3.9 crores of EBITDA, which is about 9.43%. So that is the reason as to why Arun said that, depending on the mix between prototypes and production revenues, the margin profile with respect to defense changes. It so happens that in Q1, there are substantial prototyping of around 13.87 crores of revenue. And also, because of the competitiveness as what is there in the prototype bidding now, the loss as what we took on, which is much more than the whole year loss of last year, which we had incurred for prototypes.
Understand. Thank you.
Thank you. The next question is from the line of Manju Bhashini from JM Financial Services Limited. Please go ahead.
Yeah. Hello, sir. Good evening. Am I audible?
Yeah. It's not very clear, but we can sort of hear you.
One second. Is this better, sir?
Yes.
Yeah. First question is regarding this reversal of in the employee in the notes to accounts. There is a mention about certain reversal of the share-based payments to employees to the tune of 10.82 odd crores. So how should we treat this, sir? Is this an exceptional one? Because if you do not include this, then the whatever margins that we are seeing at the EBITDA level would have been even more lower, and there would have been a significant drop on a YOY sequential basis from our EBITDA perspective. So how should we read this, sir?
So basically this is, we have programs and compensation which we roll out for employees, which are retention based, which are performance based. So I think time to time we need to review this. So I think this quarter we had a review of some of these processes, and in discussion with our board, we tried that some of the old programs need to be rolled back, and we need to sort of launch a new program, which is what we are in the process of doing. So I anticipate that over the period of the years, this is something that will balance out.
Okay, so this is based on the milestones that were set for the employees, and they have not reached those milestones, and hence this reversal of the compensation. And let us assume that things get better, etc. This cost can come back to us. Is that the right way to understand?
Yeah, you can say that. It's a combination of factors. One is partly the milestone, so there have been some stocks which have vested, but it's also in terms of the ambitions of our company, the aspirations that we have. That changes from year to year. So, when we have, a different ambition that we want to enhance our performance, we would like to revisit some of our compensation programs, and partly that's what we have done as well. So we wanted to research it to, the future growth potential and to, some of the sectors where we feel that there can be superior performance. So it's a combination of both of those.
Sure. Sir, a lot of questions were on defense and this production revenue run rate, which improvement which you talked about. Just a few data clarifications here. The Mistral revenues last year, F24 fully overall, was somewhere in the range of 328 odd crores. Am I correct in that? Vis-a-vis some 49 crores.
Sorry.
Sure. And this number for the current quarter, Q1 25, is 49 odd crores. Is that right?
No. The total revenue from Mistral this quarter is 65 crores.
55, is it? 65 odd crores. Okay. And this 65 on a comparison basis is 72 in Q1 of 24. Is that right comparison or any changes to that?
That's right.
Okay. Out of this 65 crores, you said somewhere 26 odd crores is the production revenue in this quarter of 65.
So let me break this 65 crores for you. The defense production revenue is 27.5 crores. The prototype revenues are 13.87 crores. And the semiconductor revenues are 23.62 crores.
Semiconductor is 23 point something, right? Okay.
Correct.
And the margins, the EBITDA margins on that production revenue of 27.5 crores is 24.7% EBITDA margin. Is that
That's right.
And we incurred 3 crore loss on the prototyping and revenues of 13.87.
Correct.
Okay, sure. And semiconductor is also in losses, or are we?
Semiconductor, we have made a 15% margin. On the 23.62 crores, we recorded an EBITDA margin of 4 crores.
Okay, 4 crore EBITDA is what we have generated there. Okay, understood, sir. And the visibility for this 27.5 current quarter ka production revenue is 170 crores the full year, is what you were indicating. And this number, the same FY2024, the corresponding comparable number was somewhere in the range of 112 odd crores, is it? 112 is going up to 170. That is the visibility we have.
That's right.
Okay. And this 800 to 1,000 crore of the number that is there in the presentation about our confirmed or design-led production revenues that can accrue to us, where you talked about a cycle of 2.5 to 3 years when this can be achieved. So over here, so this entire 800 to 1,000 is convertible into order book in, let's say, 3 years. And that order book to revenue could happen in maybe another year's time frame or so. So in 4 years time frame, the entire 800 to 1,000 odd crores can translate into revenues. Is that the correct way to understand?
Well, many of the radar programs and sonar programs, the revenue recognition will happen in the next 3 to 4 years. But there is also some amount of revenue in this 800,000 crores, which is part of the right propagator with Tejas aircraft. Here the production cycles are a little bit longer.
Sorry to interrupt. You were echoing a bit, sir. I got the point that in next 4 years or so, this can get translated into revenues. But after that, I lost you.
The programs which we work on today are multiple radar programs, sonar programs, electronic warfare programs. So these programs, I expect things to be recognized in the next 3 to 4 years. But whereas the revenue which we have calculated here, which is for a Tejas aircraft, the production revenue is for a longer duration. So that revenue will be spilled over till the Tejas are produced. So 100% will not be consumed in 4 to 5 years. If some of the revenue will be over a period of next 7 years.
Okay, so the revenue conversion will happen over the next 7 years, but order book conversion from this 1,000 crore could happen over the next 4 years. Is that right?
Obviously, the most important what happens is that whenever we get orders, for instance, for Tejas aircraft, we know for a fact that there were 190 aircraft to be produced. But HCL will release the order to me for the 35 numbers, 40 numbers in year on year or in every 2 years, release orders in batches. So we may not have the order for that complete not in 1 year, but here something which is orders which are secured for the future also, because that is a part which is already pre-approved.
At the same time, if you look at the other ones which are designed and under development, that also will realize into revenues in these number of years, but at the moment, we are not very clear in terms of how the program is shaping up.
Because see, in terms of 2,000 to 3,000 crores of prototypes under production, in some of these cases, our portion of activity is completed. But my system is going into a larger system. For instance, if I am developing something and then getting into a radar program, my piece which is in designed and at the start is already delivered to my end customer. My end customer is putting the radar has to go to the field trial. That's when the production will happen. So there are a little bit long cycles, but unlike in the past, when the design cycles were about 10 years, 20 years, now it is shrunk to 4 to 5 years.
Okay, got it. The translation will take much longer, could be even up to 10 years is what you're saying, because there are multiple parties involved and hence there could be a delay there. Right?
That's right.
So just on I got the point on the auto and the client-specific issues that you're having and how you believe that things can get better over the next 2 quarters or so. But aerospace on a sequential basis is largely in the current and the similar run rate only looks like. There has not been any material improvement on a sequential basis in the aerospace revenues. Is this on expected lines, or you think anything that you can elaborate here, sir, on this point?
Yeah, so this is aerospace from Q1 of last year to this year, there's been a 24% growth. From Q4 of last year to this year, it's been similar. The reason being that if you look at large manufacturing sites, whether it's in aerospace or automotive, they typically have shutdowns of 2 periods. One is the summer shutdown, which happens, and the second is during the Christmas period. So in Q1, we had almost 2 to 2.5 weeks of summer shutdown, because of which, the revenues from the aerospace segment were a little bit lower, which we expect to see that coming back. Because for us, when the factories are humming and the products are being generated, that's when the business for us is robust.
Okay, so in that sense, then Q2 on a sequential basis should be a good number to look at in the absence of the shutdown which impacted us in Q1.
Yeah, so Q2 we do expect the revenues to be much better.
Okay, understood, sir. Sir, and just another point on the interest costs. You said interest costs for the full year could be in the range of 30 odd crores vis-a-vis 53 odd crores where we closed in FY24, right? And the current quarter interest expense is in the range of 8 crores therein. So, and you have also talked about further reduction in the debt which can come through there. Can you please clarify these numbers, sir? What is the current net debt and what is the current gross debt and net debt on books?
See, the current gross debt is around 430 crores and the current net debt is about 50 crores, 50. And, I was saying the total interest cost for the entire year would be in the range of around 30 odd crores. Because we are taking some capex, we are putting in some capex for which we are borrowing at a very reasonable and competitive cost. So as a result of which, the total finance cost will not be more than 30 odd crores in that range.
Okay, 230 is the gross debt and 50 is the net debt. That's the number, no?
That's right. We are having about 182 crores in terms of cash, bank and liquidity assets.
Okay, and what was the operating cash flow? I think you mentioned about net working capital of somewhere in the range of 120 odd days or something. Is that the number, sir? Did I get it right?
That's right. But if you look at most of the engineering services business runs at a net working capital cycle of around 75 to 90 days. Whereas in the case of defense, it is a little bit more because you hold inventories as well as receivables.
Okay, got it. Sure, thank you very much, sir. Thanks for your time.
Thank you. Ladies and gentlemen, I would request you to limit your questions to 2 per participant strictly. The next question is from the line of Dhruv Shah from Ambika Fincap. Please go ahead.
Hi team, and thank you for the opportunity. Arun, my question is on your EDS segment. Now our EBIT margin is around 11% this quarter, and that also includes this 12 crores of write back you guys have done on the stock-based payment. When do you see our EBIT margin on the EDS coming back to the industry level of 13-14%? There is also industry reports around 15-16%, but when do we get to that 13-14%? I understand you are investing in automotive and energy, but at the same time you are, our EBIT margin on aerospace will be much higher. So if you can just elaborate on the same.
Yeah, so Dhruv, like I said, next quarter when we have our different production runs to be higher, we will see a higher margin when it comes to Q2. But I think for us, every quarter, we have certain the rhythm of our business. And I think this quarter, because of the fact that we had lower production as well as a client-specific issue, the margins were a little bit low. If you look at last year, we closed FY24 at close to 13% margin. we are looking at taking that up in FY25. So we have a plan in place to sort of recover that over the next 3 quarters.
When you say production, but that would be related to defense, right? I'm talking only about
engineering services. To answer your specific question, as I said, the current I would say there are 2 verticals which are undergoing correction, which is of course automotive as well as heavy engineering. To answer your question as to when we'll be able to scale up another 200 basis points, I would assume that at the end of this current financial year, we should be able to scale up at least about 150 to 200 basis on engineering services.
Okay. By end of this year. So every quarter we should see this going up from 11% EBIT margin?
Yeah, so because we are doing a major correction in heavy engineering vertical, and that is in fact that needs to be margin accretive rather than as against total margin decretive position as where it was in FY24.
Right, and Shashi, on the thing which we were supposed to start on heavy engineering to increase the margin, which we said on the last call also, is the exercise on, and should we start seeing results from coming quarters?
So it's already, let me tell you, so in fact, if you look at the total revenues of last year from the heavy engineering vertical, the total revenues from heavy engineering vertical was 152 crores last year, which with an EBITDA margin of negative 0.5%. Whereas in this year, in Q1 FY25, the revenues from the heavy engineering vertical is 36 crores, where the EBITDA margin is now 3%, plus 3%. And this correction has kicked into place largely in Q1, and there is more to come.
Right, fair enough. Thank you for those were my questions. Thank you so much.
Thank you. The next question is from the line of Jalaj from Swan Investments. Please go ahead.
Hi sir, this is Revati from Swan Investment. Thank you so much for the follow-up. I have just one question. Most of the questions have been answered. So you are sticking to the guidance of 1,600 crores of top line and 160 crores of 170
losing you. Rupesh, we are completely losing. We are unable to hear.
Is my voice clear now?
Sorry.
Yeah. So the question that I have is, if I see the guidance that you are giving for FY26, which is 1,600 crores of top line and 170 crores of bottom line. Now, considering the current run rate and considering the guidance that you are providing for this year, I think we'll be ending somewhere around 1,100, 1,150 crore at best case scenario, 1,200 crores this year at the top line level. Now, to get the 1,600 crore next year, you need to have 400 crores of addition. So, just wanted to get some sense. Do you have this kind of visibility in terms of your existing order book or existing pipeline to get this kind of number, or it's just an aspirational number?
No, these are all numbers which have a backing with respect to how this has been computed. Because the biggest driver here, of course, is the defense vertical where we have been talking about 39 crores production revenue is going to 111 crores, 111 crores going to 170 crores. And the pipeline of orders as well as the confirmed, the prototypes of what we have, resulting in the production revenues of defense going by much more multiples going forward. And of course, the other vertical with respect to energy is still a small base, but then again is going to pick up quite a lot going forward in terms of the base of what we are now in the Middle East and the various other strategic plans we are kind of getting in this vertical. So we have of course aerospace, because of the production run rate of what is going to go up and our order backlog as what the OEM has. That's another vertical which will also go at a fast rate. And the entire 1,600 crores is not purely organic. We have taken this amount of inorganic also in that, and that's something which we have to play out.
Yeah, and I think what we're also doing is that, obviously in order to realize those ambitions, we're also investing in our sales force. So we are recruiting more people so that we can improve our new logo addition and large addition. So definitely it's working for us. I mean, this is the direction of travel that we want to traverse. And, there are investments that we will plan, and we will expect that, we'll have outcomes from those investments. So not everything is in the bag right now, like it is for any other company. But, with the investment that we're putting in and with the growth rates that the industry is seeing, we feel that, this is an ambition that we can sort of work on.
Sure. If I may know, sir, how much is the inorganic, you are building in this 1,600 crore number?
About 10% is the inorganic revenue. 15% is the inorganic.
Sorry, sir, I missed that. Sorry.
10 to 15%.
Okay, 10 to 15%. Okay. Thank you so much for answering my question.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for closing comments.
We thank all the investors and the participants in this call for participating in the call, and we also thank you for your support throughout. We also thank Orient Capital for arranging this call. Arun?
Yes, sorry, just one closing remark I wanted to make is that I think, like I mentioned, as we see the industry going forward, our strengths are in aerospace and defense. And like I mentioned, we will be looking at how these are two verticals which we believe have a lot of juice left in them. So we will be, of course, all the engineering services verticals are important to us and we will look at growth. But I think as a company, we will see our pivot happening more towards aerospace and defense, and we will expect to see speed of growth coming from that. So I just wanted to leave that, and we are also looking at bringing a lot of the embedded capabilities from Mistral into our portfolio. Therefore, the logic for our rebranding is to focus the whole defense portfolio that we have. And the second is the digital engineering and the embedded capabilities that we have, which is something that we will play upon going into the future. So thanks a lot for all your questions and good talking to all of you.
On behalf of Centrum Broking, that concludes this conference. Thank you for joining us, and you may now disconnect your line.